Are you worried that you won't have enough money to live comfortably in your retirement? Or do you think that you're too young to worry about retirement? I'm Aaron Gilbert, a professor of finance at AUT Business School, and I'm here to talk to you about KiwiSaver investing. This is KiwiSaver Matters. Our first question, why was KiwiSaver established? KiwiSaver was established back in 2007 because frankly, most Kiwis are not very good at saving. Even today, we save a lot less than people in Australia, the US and the UK. Combined with the fact that superannuation is no longer enough to live on in retirement, and that for even the most basic retirement, the estimate is that you need at least $50,000 to $200,000 in savings by the time that you hit retirement. So KiwiSaver was designed by the government as a way to bridge that gap and make sure that we reach retirement more comfortably. A question I think that's absolutely brilliant. I'm only 24, why should I care about KiwiSaver now? There are two reasons why you should care. The first is that superannuation in its current form is unlikely to exist by the time that you hit retirement. Superannuation is already becoming unaffordable for the government, and they're starting to look at ways in which they can change it. I think if you're 40 years away from retirement, relying on yourself is a safer bet than relying on superannuation. The second reason is a more financy reason. KiwiSaver is built around the concept of compound interest. Compound interest basically is the idea that I earn interest on the money that I've already got invested, and then I earn interest on that interest, and it snowballs over time to become a very big amount of money. The longer you have until retirement, the more powerful compound interest is, and in fact it works on an exponential basis. So if I'm 40 years away from retirement, I might only have to put in about 10% of what I hope to get at the end. If, however, I don't start thinking about my KiwiSaver until my 50s, which is a more common time for people to think about KiwiSaver, then I have to put in about half the amount. So starting now just makes financial sense. A very timely question. How much should I worry about fluctuations in my KiwiSaver? If you're in the right fund type, not at all. The reality is that if you're in a growth fund, which are the types of funds that are most affected by the fluctuations that we're seeing at the moment, and you don't need that money for a very long period of time, you shouldn't worry at all, because by the time that you come to withdraw that money, you won't even remember about the fluctuations in 2025. A really common question is, what's the best way to figure out which KiwiSaver provider I should go with? For a start, you should be first worried about whether you're in the right fund type. And if you're uncertain about what fund type you should be in, then I suggest going to the Sorted website, who've got some really great tools that simplify that question down and will help you to decide whether you're a conservative, a balanced, or a growth investor. In terms of who should manage your money, there are three adages that I'd like to highlight. The first of those is that past returns do not predict future returns. So if you're trying to change your fund manager and you want to go with last year's winner, that's not necessarily going to be next year's winner. Over the long run, most of these funds are going to return similar level of returns when you look over a 20 or 30 year horizon. The second adage is that returns are uncertain, fees are not. If we go back a couple of years, active funds on average lost about 10%. Fund managers, on the other hand, had a bumper year. The way that your fees are charged is on the basis of how much money you have under management with that fund manager. So they are always going to be charging you fees. The third adage is pay peanuts, get monkeys does not apply here. There is no correlation, or not a very strong correlation, between the returns that you get and the fees that you're charged. So my personal advice would be to go with a relatively cheaper fund manager who is probably going to work out better in the long run. One other consideration can be whether your fund manager aligns with your values, i.e., are they investing in things that you would perhaps be uncomfortable that they were investing in. If you want to know more about what your fund manager is investing in, I suggest going to the Mindful Money website, who break down all of the investments for each fund and will highlight any areas of concern. A really interesting question. Is it worth it to pay extra for my funds to be actively managed? So let's start by exploring what we mean by active management. Active management means that your fund manager will spend a lot of time and a lot of resources looking for winners in the market. What we mean by winners is funds that will do better than the market in general in the longer term. This is a really hard thing to do because it requires predicting the future, and if we were able to predict the future better, there would be a lot more lotto winners than there are. The reality is a good analyst, a good fund manager will get it right slightly more often than they get it wrong. So in terms of active management, it will cost you more, but it doesn't necessarily guarantee you better returns. And in fact, the evidence suggests that in the long run, they don't earn enough to compensate for the cost. Passive funds, on the other hand, just invest in the market. They simply try to capture the market return. In essence, they're working smarter, not harder. So another question, are ethical KiwiSaver providers really ethical, and how do I switch to one? It's important to consider that ethical isn't really a legal term, and fund managers can label themselves ethical, balanced, sustainable as they choose. If you as an investor want to be an ethical investor, then one of the things that you'll need to do is actually look beneath the surface and see what they're investing in. As I said earlier, there's a great website, Mindful Money, which will allow you to actually investigate what they're investing in. The other thing is that what is ethical to your fund manager may not be what you are interested in investing or what aligns with your values. So having a really good look on the Mindful Money website will allow you to see whether your fund manager is more interested in environmental concerns, human trafficking, slavery, animal abuse, whatever. And how do I switch to an ethical fund manager? Once you decide who you want to look after your money, then all you have to do is go onto their website, fill in the application form, and in a couple of weeks, you'll be a member of that fund. A bit of a harder question to answer. I'm worried that I won't have enough money saved to live comfortably when I retire. How much do I need, and what's the best way to help me get there? The question of how much money you need for retirement is very much a personal question and really depends on the type of retirement that you want to have. If you want to be traveling all over the world, if you want to be buying new cars, boats, etc., then you're obviously going to need a lot more money. Evidence suggests that to have a reasonably comfortable retirement, you need between about $750,000 and $1.2 million. And that will probably seem very daunting for most people. So how do I get there? KiwiSaver is a really good tool to get you there. What you need to be mindful of is the fact that the minimum contributions may not get you there. The things that you need to consider: how much can I afford to contribute, and am I contributing enough? And is my money in the right fund type? The higher risk you take, the more returns you'll make, the more money you will have at retirement, and the better your chances of hitting that comfortable retirement are. Okay, when should I have my money in a growth fund? A growth fund is a fund that is predominantly invested into stocks and property. And what that means is that it's going to give you great returns over the long run, but it will be a bumpy ride. There'll be a lot of volatility, there'll be ups and downs. Now, if you don't need your money for at least 8 to 10 years, then that's fine, because the markets tend to do these boom and bust cycles over about a decade. So if you don't need your funds for a long period of time, i.e. you've already got the first house and you're now saving for retirement, then a growth fund is a great way to maximize your savings and make sure that you've got the best chance of hitting a very comfortable retirement. So another interesting question. I just got a pay rise at work. Is it better to throw the extra money at my mortgage or to put it into my KiwiSaver? This is a question that a lot of people are going to be trying to decide. What do I do with that extra money, other than just spend it, of course? It depends a little bit on a few different things. If interest rates are low, then the amount of benefit you get from paying off your mortgage quickly is relatively low. So you might like to put the money into the stock market, into an ETF, any sort of investment product that's going to earn you more than you would be paying in interest. And what that means is that over the longer run, you'll actually be better off overall. Is KiwiSaver the right way to do that? Possibly not, because KiwiSaver actually limits when you can withdraw your money. First home, financial hardship, when you turn 65. So a better option might be to actually put the money into the financial markets through other tools, other managed funds that are not KiwiSaver, or even just simple ETFs, and then you get the best of both worlds. The money is available if you need it in the future, but you also get the benefit of the extra return. And by the way, when I say ETF, I mean an exchange traded fund. These are a simple way of buying the entire stock market without having to buy every single stock. So a question I might get into trouble for answering: what about my interest-free student loan? Should I pay that off first or chuck any extra money into my retirement scheme? The reality is, I wouldn't advocate paying any extra off your student loan unless you were planning on going overseas in the next little while. The reason being that over the longer run, inflation will actually reduce the value of your loan, especially as you get pay rises to compensate for inflation. So you're actually better to let inflation eat away at your loan than you paying off extra off it. So if the choice is between paying off your interest-free student loan or putting money into the markets, I vote the markets. A very important question: what specifically should women do to maximise their KiwiSaver? There are 3 reasons why women hit retirement with less in their KiwiSaver than men. The first is the gender pay gap. Because of the way that KiwiSaver contributions are calculated as a percentage of your income, if you're earning less than your male counterparts, then you're contributing less to your KiwiSaver, which means that over the long run, you'll have less. The second reason is that women tend to be more risk adverse. And what that means is that they tend to put their money into safer funds, which earn lower returns. So how can women overcome these 2 problems? 1, they can contribute a higher percentage of their salary than their male counterparts. The second, overcoming the risk aversion, they can try to take on more risk and put themselves into riskier funds than they might ordinarily be comfortable with. The third reason is because women have periods of unpaid leave, specifically things like maternity leave, which means that they're not contributing to their KiwiSaver while they're at home looking after their children. This is a structural problem and is one that probably requires the government to try and look at. At the end of the day, we don't want to penalise women for producing future taxpayers. Another really topical question: I genuinely want to save for retirement, but is KiwiSaver the best way to do it? Is it the best? No, but it's the best that we have at the moment, and it comes with some really big advantages. If I contribute to my KiwiSaver, I get employer matching and I get government tax credits. That's essentially free money that is going to help me to boost my retirement savings. One big negative over KiwiSaver at the moment is the simple question of whether I'll hit retirement with enough money to be comfortable. And this is an ongoing debate. Realistically, we probably need to be contributing more to our KiwiSavers. Otherwise, however, it's the best system that we've got, and I would really implore people to make the best use of it. A bit of a fraught question. What are the chances that the age of retirement will go up and I won't be able to access my KiwiSaver funds at age 65? It's really likely that we're going to see changes in national superannuation. And one of the easiest ones will be to increase the age of retirement. There's already been discussions about it going to the age of 67. I think some other changes that we might see in superannuation, which are potentially more problematic, is moving to a system like they have in Australia, where superannuation is both means and asset tested, which essentially means that superannuation won't be available if you are earning or if you have too much in the way of assets. I think the further away you are from retirement, the more likely you are to be impacted by some sort of changes, although we don't know what the changes will be. And therefore, it's best to try and build as much wealth into your KiwiSaver as possible so that you can ignore whatever the government is going to do. Thanks for all your questions. I hope the information I've provided is helpful. You can find more information in the show notes. Thanks for watching KiwiSaver Matters.